Welcome to this week's strategy session. Great having you with me for another show, and heaps of interesting things to talk about this week with so much volatility coming into the market, some movement in some of the commodities. And I also want to have a look at some of those stock codes that you're interested in. So we'll go through them towards the end of the show and look at the technical structure and what could be happening in those. So get those ready for a little bit later on in the session. Now, as always, everything today is general commentary only, doesn't take your personal situation into account. Been through all that, let's get into our first chart. So we will start off, as we always do, with the ASX 200 and the selling. The selling in the ASX 200 has moved into its second week, and the All Ordinaries has actually seen 8 down days in a row. So I'll tell you about the last time that happened in a moment. And of course, I think the big question everyone's now focused on is, was this a final high in early February, and how much more selling could there be yet to come? So I've got some charts to go through to help build a framework around those questions, and also consider a strategy for dealing with the evolving price action that we have. But let's start by talking about this 8-day sell-off. And what I'm going to do, I'm going to switch to a chart for the All Ordinaries, because this is of course the ASX 200. And the ASX 200 didn't have 8 down days. There were some minor up days in between. So I'm going to just switch over. Let's go over to the All Ordinaries. And the thing with the All Ordinaries in the ASX 200, whilst the indices are a close match, the different combination of stocks means that they aren't an exact match. And the ASX 200, well, it has been slightly more resilient during this selling we've had over the last couple of weeks. So let me start by saying 8-day sell-offs are rare. The last one came, it was back in, the one that came close, the most recent one that came close was in June 2022. You can just scroll back. I've just highlighted it here in blue. That was a 6-day sell-off, and even the COVID crash didn't quite make it to 8 days. Scroll over and have a look at the COVID crash. It got to 7 down days in a row towards the start of the that big COVID sell sequence. And let me just head this off by saying I'm not suggesting anything similar is about to happen. I'm not saying that in the slightest. But what we need to do, we need to go all the way back. I've got to compress this chart a bit to get back there. We've got to go all the way back to 2008 to get a sell sequence of more than 8 days in a row. In fact, this was 12, and this was during the initial wave of the GFC. So that's where these are the previous times we've had these sequences. Let's come back. Let's bring it back to where we are now. And so what does this 8-day losing streak? What does this 8-day losing streak tell us for where we are now? Well, for one, I don't think it predicts anything. I don't think it's predicting anything like those 3 episodes we've just been across. The 2022 and the 2008 examples, they both occurred when prices were already below declining moving averages. So they came when the market was already in a vulnerable state. This is a market which is in a different position. It's just come from an all-time high. So it's quite a different setup to what we have now to start with. But I think what it does demonstrate, I think what this 8-day stretch of selling does demonstrate, I think it's showing that there's a hesitation for investors to step up and buy the dip. And I think that's something to take notice on. I think we want to really be aware of that fact that the buyers are hesitant to step up during this decline. In itself, this is not a sell signal, but I think it does highlight at least a near-term vulnerability. Now, I want to come back and have a look. I'm going to come back to the ASX 200, leave the All Ordinaries, back to the ASX 200. So prices have been below. So I've got the 50-day and the 100-day moving averages. Prices have been below this 100-day moving average for about a week. Now, it's only a week, and a week doesn't tell us a great deal. That said, though, it's the longest stretched below the 100-day moving average since you've got to come back down here into November 2023. So I think that the absence of a strong buy the dip reaction over the last couple of weeks suggests that maybe there's some more downside risk in this still before we get a strong, or before we get some sort of a rebound. I think keep an eye on support at around 8,100. Now, this has been a technically active region going back to July last year. You can see there's been a number of times where the market tested it from when it was resistance and then tested it when it was support. So now it's support. Keep an eye on that. I wouldn't be surprised to see this region come into play again. And one thing to remember, just remember, like last week, we were discussing how tops form. You might remember we went through some examples from previous peaks in the market. Essentially, I was saying that they take time to develop, and that one down week or maybe two down weeks, it doesn't signal a top. It's just like it's a down week or a couple of down weeks. It doesn't signal a top. So nothing has changed since then. It's we've still only got a couple of down weeks. It's really it is a short period of market weakness from an all-time high. So from that perspective, I think it's way too early to say the bull market is over. In fact, I think the odds still favour the bullish side, but we do have some cautionary signs. So the first one being the lack of buying of this dip so far, and that prices have been holding below the moving averages. They're both classic signs for caution. Now, neither are a sell signal, but they're signs for caution. So there's a distinct difference between the two. I think the next rebound will tell us a lot. So do we get a strong rally off the lows? And if we do get a strong rally, well, that would be a sign that buyers are now starting to step up and start to want to really accumulate stocks at these lower levels. Or do we see prices struggle to make headway, and do they continue to get stuck below the moving averages? When you see that type of situation unfold, it's often a sign that demand is weak and there's selling into the rally. So that's why I say the next rebound could tell us a lot. Is it strong or is it muted? I think the way to play this is to be guided by the price action. At this point, the trend remains up. This remains an upward trend. It's been the case for over a year now. At this point, that remains the situation. But it is an uptrend that is under pressure. As I say, the longest spell below the 100-day moving average since 2023. So there is some pressure being applied to the trend. For me, this all means maintaining long exposure, because, well, I don't want to sell every time we get a 2-week pullback. If I was selling looking for a top every time there's a 2-week pullback, I'd almost never be in the market. I'd always be jumping at shadows and getting out. So it doesn't really work when we do that. That's why I say these things take time to evolve. You've got to be guided by the price action. But I am reducing some risk. So I'm exiting stocks that hit their exit levels, their trailing stops or their stop losses. I'm happy to, of course, as I always do, I sell them when a stock hits its exit point. I'm out. And I'm also happy to have a bit of extra cash until we get a clearer picture develop. I think there are all sorts of ways this could play out. So one example, we could get a multi-month consolidation where prices chop sideways and the price action just gets messy. And then later in the year, we could see all-time highs. So as I say, it's too early. I think it's way too early to say the bull market is over, because there are many ways it could play out. My number one strategy for these periods, when things do we get that heightened uncertainty, my number one strategy, it really comes down to using that wide, calculated trailing stop, which I often talk about. So it's not about using gut feel. It's not about being swayed by emotions, reading the headlines. It's about having a calculated exit strategy. So if the price action deteriorates, Stocks come back to their exit points. It's a clear-cut decision to sell them, protect capital, move to cash, and then I want to give the uptrend every chance and give it plenty of room to move. And so that's what a good exit strategy is all about. It gives you every chance of staying on board, gives it the benefit of the doubt until it comes time to say enough's enough. And it's a clinical, unemotional sell. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. Tells YouTube you're watching. YouTube shows other people. It helps me heaps. So please do those things. Now, we're going to jump over to the US market. And then after that, we've got the local small caps, the US small caps, all the commodities to go through. And of course, your stock codes too. So get them ready for a bit later. But before we do that, let's jump into the US markets. So I've got the S&P 500 to start with, and there's been some significant price action in the last week. And unfortunately, there's been a negative focus to that price action. A key feature that we've been tracking had been this tight compression trading range that developed from the January high. So we had that nice strong rally from the January low to the high, had a sideways consolidation along the moving averages, formed this tight band. And so that's been the big focus point. And often we see these develop after rallies, and they often work as holding patterns before higher levels. Now, as we talked about last week, there was a breakout a couple of weeks ago from this range. And so that was a bullish sign. That often leads to follow-on buying, but that wasn't the case in this instant. There's no sure thing with these setups. Nothing works all the time. We can put the odds in our favor, but nothing works all the time. So here we've got this situation where prices are broken higher, and then they've quickly reversed last Friday. We've had this sharp downward move on last Friday, and that leaves behind what we call a false break. So I'll talk a bit more about false breaks in a moment. Now, before we do that, I want to jump over and go to the Nasdaq. Let me just get the Nasdaq chart up here. And this was a focus. This was a big focus of last week's session. What had been going on with the Nasdaq, and the center of attention was, of course, this big 2-month trading range that had formed in the price action, and that was below the December high. So December peak, then we've got this big sideways move along the rising moving averages. So it's been a situation where the market had been resilient to potentially bearish news. There have been several incidents through this 2-month period where where bearish news came out. The market held together quite well, which is often a bullish sign. And then we got a break to the top side out of this range. So that should have been bullish. But like we saw in the S&P 500, the breakout failed last Friday, with prices falling back into the range. And this was a possibility that we discussed last week in the strategy session last week. And I said that while I wasn't expecting the breakout to fail, I'll always back a breakout to be successful. While I wasn't backing it to fail, it was something that I was watching, just given the underlying movement across markets generally. And when you do get false breaks, they're warning signs that maybe something isn't quite as it should be. And this is the thing with false breaks. The lack of follow through buying, you get the break, and if you don't get that follow through buying, the lack of that follow through buying and the increase in selling is a sign of technical weakness. And if a market can't move higher when all the things are in its favor and it's breaking upwards, if it can't move higher, then it's a case that more often than not we see that the market will then test lower, and that's what we've been seeing over the last week. Now, this doesn't mean the overall upward trend is finished. I think a lot more needs to happen before we can say that. As we discussed last week, big tops often take time to develop. But the price action that we do have with the false break and then the selling through the week, the price action we have does suggest there's cause for caution, and maybe maybe the scaling back of a bit of risk. And that's what I've done. So what I did, so when I got up Saturday morning, the US market is still open. It's in its last half an hour of trading. I saw we had the false break, so I sold my S&P 500 ETF. So on Saturday morning, near the close of trading on Friday in the US, and I sold my. Then on Monday, I had an ASX listed US focused small cap ETF position. I sold that on the Monday. I'll go through the US small caps in a moment, which is also interesting. I'm still considerably long the market. So it's not like I've just gone out and sold everything. Far from it. But I have trimmed the sales, particularly in the with the US exposure. So coming back to the S&P 500, let me just get that back on our screen. So coming back to this, at this stage, this is only a pullback. If we look at look at the scope of this upward move over the last 2 years, what we've got so far is not really much different to so many of these other periods that we've had over the last couple of years. At the moment, it stands as a pullback. There hasn't been a structural change to the underlying price action. And by that, I mean the moving averages are still generally moving higher and prices just dip below the 100-day moving average at this point for a day. It's not a structural change to the price action. It is interesting that there are two false breaks within a month of each other. So the first false break was in January. It was a false break to the downside. And then just recently, we've got this false break to the upside. So that's a sign that the market lacks conviction in either direction. And maybe that suggests that a multi-month period of messy price action is what's ahead of us, where conditions just get more difficult, and there is more of this chop where markets rally and they pull back and they jerk higher again, and it becomes difficult. That is part of the cycle as well. And I think this is another reason for maybe a bit of de-risking, and that's when this heightened uncertainty starts to appear. De-risking can sometimes be a good way to manage some risk. I think clear trending markets, they will return. They always do. Clear trending markets always come back, but periods of chop and volatility, they're also part of the stock market as well. And this is where our strategy for protecting capital comes into play. It's all about minimizing those losses when it gets more difficult and patiently waiting for the next round of bullish breakouts, because they will happen. It's a matter of when, whether they be in the near term or whether they be several months or longer away. The buying setups reappear. It's about protecting capital in the meantime whilst we're going through choppier, more uncertain conditions. Okay, so I'm going to jump over to the US small caps now. Then we'll go on to the small ordinaries, the commodities, a couple of stocks for you. But that wraps up the free section. So if you're not a strategy session member, there's a link below. Click that, come on board. I think you'll find lots of interesting stuff as we go through the rest of the session, and it doesn't cost very much either. So think about doing that. Now let's move on. Let's move on to we'll start with the Russell.